You can.
That's okay. No, no one needs my introduction. It's fine. I don't think people are interested.
So I'm Leon Chen. I'm a partner at the Column Group. I would call myself sort of an entrepreneur and investor. I started my career as an entrepreneur out of academia as sort of a PhD scientist. I've spent the last 15 years in venture capital firms, but I would say I spent most of my time either building companies for us to invest in, running those early stage companies and quickly replacing myself as CEO, or being co-founders and just getting companies off the ground. So while at the Column Group, we are a VC firm and we are investors by trade. Most, if not all of what we do is starting companies to invest in. And so I continue to operate that space.
And Leah, could you remind me when did you enter into the industry, either on the company side or investor side? When was that first time?
Yeah,
Remind me.
so my first startup was right out of graduate school in 2001.
Oh,
And so I that was the real good old days. That was even before the '08 crash. Yeah, so I co-founded a company back then with my professor right out of grad school, being like a 27-year-old kid who didn't know anything, was there for about 5 years, built that company up. And in the context of what we're going to talk about today, that company throughout its entire 10-year history, I think raised about $75 million of equity and ran four clinical stage programs before it was acquired by Amgen. So the theme of efficiency has kind of has shifted a lot from those days to what we're dealing with today.
yeah. I think one of the things that definitely has happened is there's just a lot more money, right? Like, and we'll talk about that shortly. But the whole purpose of today's sort of discussion that Leah and I are having is just sort of what was biotech like before and what is it like now? Is it better or worse? So I think generally we think things are less efficient, but maybe to throw some numbers around that. And I'm not sure with this technical issues whether or not we'll be able to flash up a slide or not. But maybe Leah, you could talk a little bit about sort of, oh, I think we see the actual
Yeah.
slide here. So this is good. Some visuals. I think it's maybe the first time we have visuals on one of these webinars. But talk to us about sort of just what this chart is showing us.
Yeah, I mean, I think over the years, venture capital is not a particularly old industry, right? But if you trace back the number of dollars that have been invested into venture capital firms, so these are not dollars being deployed by venture capitalists, but these are dollars that venture capital firms have raised with a strategy that's focused on healthcare. And in general, I think you could see from the very rapid escalation, the amount of money that venture capitalists has raised has not only increased, but sort of exponentially increased through the late 2010s and into the 2020s, right? And what we're looking at is now venture capital dollars coming to the industry that are at a clip of, even inflation adjusted 5 times what we were dealing with in the early 2010s kind of era. And prior to 2010, I would argue the numbers are probably even smaller. I know the data isn't as strong there, but my guess would be that the dollars in the industry were even lower back then.
Yeah, that's just the private capital. If anything, I think in the public markets, we've seen a similar type increase, if not possibly even more. So there's just a lot more money, I think, that's out there. And I don't know that that's actually translated into better outcomes or efficiency, right? Like we've seen like a 5x increase in the amount of dollars at least being available on the private side. We are not seeing 5 times the number of drug approvals, and particularly from biotech. And so there is this little bit of the disconnect. And maybe just to sort of highlight further how biotech used to be, because maybe for many of our listeners, they weren't really in the industry back in the early 2000s or even the 2010 timeframe. I think we've got another slide to sort of highlight at least two examples of companies that really sort of, I would say, if you look at them today, would be considered like really atypical. So the first one I want to highlight is this company called Cougar Biotechnology. I mean, first of all, check out that logo. I mean, man, like a real cougar. That's like so interesting. I'm not sure any company would do that today, but this is a company back in 2008. So if you look at the public filings, this is a public company. They had a phase 3 prostate cancer program. They actually were running 2 trials at the time. Had a phase 1/2 breast cancer program and a multiple myeloma program and two preclinical programs. And look, this was also a publicly traded company. Their total number of FTEs was 54. And I think I've heard some people say, oh, well, maybe they use a lot of consultants or external parties, et cetera. But the total amount they spent was only about $60 million or so. And so, regardless, this was quite efficient. And again, even if you inflation adjust this, you're talking about less than $80 million a year burn for this amount of programs. And then if we just fast forward a little bit, a few years, then there's another company called Tesaro. This was another company that was public. Now we're looking at 2012. They had a phase 3 program that was ready to go into breast cancer, but we're also exploring 5 other indications. They had an ongoing phase 3 program in chemo-induced nausea, phase 1/2 oncology program, and they were doing this with 37 employees. So and they only spent $62 million in 2012. And so again, I think for any of us that are working in a biotech today, we clearly sort of would see that these would be considered highly atypical, both in terms of the number of employees as well as the amount of money they're burning, particularly as a public company. And so I'm like, so what happened, right? Because clearly this is not the prototypical biotech company today. How do we get here? What is the problem before we get down towards what can we do or what can we suggest could be done to make things better? So I'm not sure, Leon, if you have any thoughts around what happened, right, between 2001 or 2012 and today.
Well, I mean, I don't know that you could speak to any one particular thing, but from an investor side, if there are just more dollars in the industry, the supply and demand would say that if you can raise money, you should. That's historically been kind of the management mantra, that we hear time and time again. And I think what we see is that if management teams have more capital, they will find ways to spend that capital, mostly in the same kind of time periods of year and a half, 2 years runway. I've never seen a company raise $500 million and suddenly say, we've got cash for 7 or 8 years, right?
Mm.
Everybody has a 2 year runway on average, regardless of whether you raise $30 million or whether you raise $300 million, it seems like. And to the point about efficiency, I don't know that that actually means that you've scaled the number of clinical trials or actually drugs that you actually are pushing into the clinic. They largely kind of all regress back to the mean with 1 to 3 kind of pipeline programs that are meaningful. So I think it's a little bit of human nature, right? If the capital's there and you can raise it and you're not incentivized not to take it, um, you would be incentivized still to spend it and try and scale what you're doing with more enthusiasm, probably with the same level of results, right? Would be sort of my take.
Yeah, I mean, it seems like maybe we're bloated, right? And we sort of the industry needs our GLP-1 moment, right? Because like the percent of companies that are overweight is too much. I mean, and it's not just companies. I would say it's also probably funds, right? I mean, when I'm always amazed when I'll look at an industry press release and there's like, oh, another fund raises $1 billion plus or $2 billion, and I think that kind of contributes to part of the problem too, right?
Yep.
Investors have more money, so they need to give companies more money. And in a way, not to go down too far of a rabbit hole, I do think that in investment funds, there's kind of a misalignment of incentives because many people may know this sort of 2 and 20 rule. Now, there's a little bit of variance on this, but generally, what that 2/20 means is that funds will charge a 2% management fee on the assets under management. And then there's a 20% carry, meaning that, eventually especially for like a venture fund, 10, 12 years down the line, when the fund starts liquidating, that for anything above and beyond that they raise, the fund managers would take 20% of the profits. But let's focus on that 2% number, that 2% management fee. You're like, oh, that's not too bad. But I don't know, like, if you're at $100 million, that means you're getting $2 million a year. The investors are allowing you or giving you $2 million a year to manage yourself. But if you're at a billion, it's $20 million a year. And if you're at 5 billion, then you're talking $100 million a year just in management fees. And I think as a fund scales up in size, it doesn't correlate linearly with the number of people that you need to run that fund. So you've got sort of this sort of odd incentive almost for funds to raise as much money as they can if people are willing to give them the money. Because, if you've got let's just call it, if you've got $1 billion fund or a $2 billion fund, you're talking about a difference in management fees of 20 million a year versus 40 million a year. And it doesn't cost that much to really employ some people to be an investor. So that money goes into your pocket. So again, we could talk a little bit later on sort of like, how do we fix that? But I guess if the buffet is open, right, for both companies and investors, it's hard not just to grab that extra crab leg or piece of steak, even though you're full.
Yeah,
Um,
I'll take it a step further. I think just on the 20% is where you are in line with your LPs, right? So if you raise $1 billion fund and you want it to be a 3x fund, you have to return $3 billion to them, which if you own 20% of your companies at the time of liquidity, which is a pretty high number for a lot of people, we're talking about $15 billion of exits, right?
yeah,
I mean,
yeah,
that is so the larger the fund gets, and we struggle with this, right?
mm,
We've had opportunities to raise larger funds, and we've tried to consistently keep our funds to a modest size because we realize the bigger they are, the harder it's going to be for us to actually generate the type of returns that we actually want, even if the management fees are more lucrative.
yeah, yeah. Good discipline. Not sure if everyone has that. I think what we want to do is, aside from talking about the good old days and what the problems are, let's figure, like, can we provide any perspective to the listeners around what can be done? And so what we're going to try to do is provide some, at least again, this is, I think, Leon and my own individual views, right? And there's nothing to say that have it figured out, but you're basically talking to two middle-aged guys, right? And middle-aged might be a stretch. I mean, older guys who have seen the industry over the past couple of decades. And rather than just being like, oh, remember the good old days, I think, both of us are still active, Leon as an investor, me as an operator. What can we do, and what are some practical things we can do, both for operators and investors, to try to get back to an industry that's a lot more efficient? So, you know, not in any particular order. Maybe I'll just start. I think from an operator perspective, I would say there's this idea of the killer experiment. You hear this, people like, let's go do the killer experiment. What does that really mean? I mean, to me, the killer experiment literally means, can you do the experiment that will kill the program? I think sometimes people think killer experiment as being like the thing that's going to be really cool or generate really good data. But I think my mindset, when I was an investor as well as I've been an operator, is, can I identify the reason or the data that would allow me to stop this program, to literally kill the program? So it's a mindset. What I see a lot of operators now today is they're trying to generate data to support the rationale to continue a program, versus, my whole thing is like, well, what's the data set or the experiment we can do so we can kill this program? Because if we know what that is and we can't kill the program, then probably it's justified to continue doing it. But again, I would just point that out, is the word killer experiment really means generate the experiment where you can actually kill the program, which might mean shutting the company down. We'll talk about that later. But again, let's do that, right? About killing the killer experiment. One thing maybe I'll ask you, Leon, is, someone asked, we actually fielded questions before we started, and not to disclose exactly who it is, but Jennifer had asked us about staffing. Like, who do you need to hire in the first few years? So how do you think about that as an investor and a board member?
Yeah, it largely for us, it kind of depends on the quality of the leaders that you end up hiring at any position. So functional title is somewhat fungible for us. If it's a early clinical stage company and you've already raised enough money for them to just get started, I'm not sure you need a CEO necessarily, right? If you have a phenomenal CMO and he's great at leading and functionally running the clinical development that you need, you can maybe wait to hire even a CEO in some cases, right? I think the general thematic for us is sort of build what you need as you need it, not necessarily way in advance. So a lot of times we see these early stage startups seeking to hire a CFO, for example, as one of the first hires. I mean, when we're starting the company, we're launching this with a full financing, right? Presumably you have 2 years of cash. I'm not sure why you need a CFO, for example, or early
Mhm.
platform companies hiring business development at right out of the gate. I mean, we don't even have labs, or we're not even generating our own data, right? I don't think we're in the business of flipping ideas and selling hopes and dreams to that extent. I mean, we're always selling hopes and dreams to some extent, but that feels a little early, right? So I think it's sort of build it as you go. I would also say early on, we like to focus on hiring athletes rather than specialists, right? I mean,
Mm.
I sometimes need, I'm much better off hiring a decathlete than I'm hiring the fastest sprinter that I could possibly find because they can cover a lot of different bases. They can do more than just one job. And that's a lot of ways that you can stay lean and stay small, especially early on.
I think that's a great point. Hiring the athlete, I sort of subscribe to that view as well, is find someone who's versatile and willing to do many things rather than someone that can just do one thing really, really well. I'm gonna, it's an interesting thing when you said, well, maybe you don't need to hire even a CEO early on. I'm gonna sort of have a counterpoint to that. Because my view is, I think the CEO is the most important person to have at any
Could
stage of a
be.
company because you need someone who has that overall view and picture of what needs to happen, right, to navigate through things. It may be, though, that the phenotype of your CEO could evolve as the company goes from one place to another. So maybe you have a more technically oriented CEO in the beginning, maybe you have a more clinically oriented CEO if you're in clinical development, and then maybe a more commercially minded CEO later on. But I do think that for the CEO, you need that person, particularly in the early days, to be highly versatile and willing to sort of do whatever it takes. So, from my own personal experience, like when I've started several companies. I mean, I'm the guy who's setting up the email accounts and the IT systems and the basic budget, and I'm going to Target and Best Buy to buy the microwaves and the office pens, etc. And so, I'm coming in, as the person kind of wearing all the hats, and then trying to figure out, okay, well, what else do I need to really drive the critical experiments, the killer experiments forward? But I couldn't agree with you more that like what I've seen happen over the last 15 years is, you see these new companies launch, right? Series A, and they're like, oh, this is our CEO. Oh, and here's our CFO, and here's our CSO, and here's our CBO, and here's our chief people officer, and here's our chief commercial officer, and you're a preclinical company. I'm like, what
Yeah.
what is happening? Right? I mean, the number of senior people, and I'm going to call out a specific few functions that I think are not needed until very, very late in the company cycle. So I would say I believe from a BD perspective that BD should be driven by the CEO. I mean, like what company? I mean, usually you're working on a limited number of programs. I mean, if you're going to go out and talk to a strategic about what you're doing, it should be the CEO leading that discussion, right? Not some person you're hiring. And it's not like you're trying to do tons and tons of deals a year. The other hire I agree with you is that a CFO is not necessary unless you're planning to take the company public in the relatively near future, because otherwise you can get by with just someone running the financial operations. And I think the other one is, again, I'm not sure how popular this will be, but I do not hire anyone to lead HR until we're at least 100 people. Now people think, wait, that's kind of crazy. What are you doing? Well, I use a third party PEO like Trinet or something else. And look, the reality is the CEO should be setting the culture. Um, and I would say that this idea of like hiring a chief people officer, someone that's trying to establish culture of this, I mean, again, my view is, we're all set on a similar mission here. And, we don't always get it right. And employees don't always get it right. And no one's keeping you here to stay at the company. So the easiest HR policy is if someone's disgruntled or is not happy, is like, just leave. Right? So let's not figure out how we change the fabric of the organization to accommodate one or two people. Let's just say you should leave. So Yeah.
Ken, I think you're absolutely right, provided that the CEO is willing to do all the things, because all of those things
Right.
end up stacking more responsibility and more weight of the world
Yeah.
on whoever is leading the organization, the one to two or three people you have left. But I don't think it's not doable. I think it's totally doable, right?
Yeah. I think a couple other things, because I've run several companies, and maybe we can get down towards maybe what can investors do is, again, just try to be helpful here to those who are listening, and just sharing what we're doing is, I would say number one is shorter and fewer team meetings. I would just say let people dismiss themselves in the middle of a meeting. You might start a meeting, there might be 8 people there, but if someone's like, actually, this is not relevant to what I'm doing, rather than them opening up their laptop or their phone, they should just get up and leave. And you just got to establish a culture where that's acceptable. I would also say force decisions to be made at the meeting and don't table things. And the other thing that I've done, at least from my end, is I do try to maintain smaller boards. I think frankly, I think the ideal number is maybe 5 or 6 at the most if you're a private company, because otherwise you're just spending your time scheduling board meetings. And again, you and the management team should be able to know what you need to do to run the company. And so adopt more of a ask for forgiveness rather than permission policy with your board. So I mean, you don't want to do anything super crazy, but don't keep on asking for permission to do stuff, right? I mean, the board and the investors have entrusted you with money to go off and do things, and so do it. Um, and I think around decision making, especially, I think we need to remember that companies and the way decisions are made is this is not a democracy. And actually, I'll share that sometimes with my team is, look, I want input, but at the end of the day, we're not going to take a vote on whether or not we do something. And I think as a strong leader, you need to be able to drive things forward that maybe doesn't completely align with your team. But if you have that high conviction that that's the right thing to do because you see the broader view, then you should probably do it. Um, so, that's the operator side, but like Leon, maybe on the investor side, like what can investors do to help our industry be a lot more efficient?
Yeah, I mean, I'll tell you a strategy that we tend to take, right? With every company today, especially in today's market, you can't really assume that you're going to get step ups in value as you go from an idea to a development candidate to an IND. People really want to see clinical data before you're actually going to get recognized for all the work that you put in. And I think that the natural inclination for management teams and to investors is say, oh, then we should just upsize the Series A. It should be $150 million from the beginning, right? But I think that is precisely what breeds some of the inefficiencies that we've talked about at the start. I think the relationship ideally you'd like to have with your management team is to say, look, we're gonna we're gonna continue to fund you as long as you're making great progress. If you're being capital efficient and you're making good decisions and you're making great progress, we're just gonna keep plugging along. You don't need to raise money with 9 months of runway or 6 months of runway. Just keep collecting the data. And if the data looks great and we are all aligned on what you're trying to achieve along that way, I'm going to be the investor that says, I don't want you to sell stock to someone else. I want to be the one
Mm,
that buys that stock. I will continue to put money into this company, right? Rather than management teams needed a plan, 6, 9 month runways where they're out on the road, going out there in these massive financing efforts. Your insiders should be your strongest supporters. They should be the ones buying up all the stock along the way,
mm,
at least until you get to that massive inflection point, which we would all agree would be some meaningful clinical data, right? So these periods that used to be Series A's, B's, C's all along until you get there, they can be the same set of investors, but I wouldn't put all the money in all at once because I think that breeds bad behavior and inefficient decision making. But the counter to that is investors need to be counted on to be there for those companies through thick and thin, through hard times. And I think it's the concern that your investors are going to leave you hanging out to dry is the only reason why you go out there raising earlier, right? And the most efficient companies that I've been a part of have been ones where you have that very deeply established relationship where you're like, no, just keep plugging along. If the data looks great, trust me, the money will be there. If it's not there from someone else, it's going to be there from me, right?
So what happens though if things are not working out? What happens if the lead investment thesis is a bust, the lead asset, you get the data, you flip that card and you're like, well, the
Yeah.
p value is 0.6.
We've definitely, so our, just oversimplifying it, right? Every successful endeavor for us is a combination of a fantastic team and a technical success of some kind. And we're betting on risky technical successes. And there have been plenty of times you have the technical success not come to fruition, but the management team has been done a phenomenal job. We have absolutely doubled down on that team, either in that construct or in another, depending on what is the most practical thing to do. But we will double and triple down on those companies and those teams that perform in this particular way, right? I don't think that there should be an attribution necessarily with a technical failure to a management team's failure. Those two
Right.
things can be mutually independent from one another. And I think if everybody understands and agrees that way, I think we can operate less out of a mode of fear and like trying to save ourselves to death and more out of the goal of being efficient with every dollar that we spend.
Yeah. I think the one thing though that I've noticed is that there is a fear or hesitancy to shut companies down, right? I mean, the way I sort of think about this is, if you're a company, especially if you're a private company, your lead thesis has been busted. Look, your value is down substantially. And I also just think like if the lead thesis is busted, then return the capital to your investors. If you have another idea to go after, then let the investors decide whether or not they want to give you that money back in the new company construct. I mean, again, like I don't want like, people might be looking at this webinar and be like, oh my gosh, but look at Ken. He just launched Ken. He raised $370 million. And so, yes, we did not, I would say one, we did have an incredible amount of demand. So we actually raised a lot less than we could have, which sounds crazy, but it's a reflection of the current environment. But I think investors knew that if our lead thesis did not play out, I was going to shut the company down and give the money back, right? And so rather than doing a series A, B, C, D, I think if you got the right management team that actually will shut it down and return the money, which we don't see enough of, then I think you can still be efficient, even though it may look like you have a large capital raise. I think like, look, we could go on for a long time, but what we want to do is, one is we want to keep this webinar relatively efficient as well. But I think we have a few minutes to maybe take some questions. I don't know the best format for that. I'm not sure if someone can see or if Elaine, who's sort of lurking in our background, is able to tell us if there's a couple of questions that we should respond to, but we're happy to do that sort of in these last few minutes.
Instead
Let's
for
see
us to
it.
look in the chat.
Look in the chat. I'm on my phone. It's going to be hard to look in the chat. So, Leon, maybe you can look at the chat for us. Is there such a thing as a team that's too lean?
I
Mm,
think it can happen. It absolutely can. You can definitely burn people out, right? So
yeah.
I don't, we're not trying to starve ourselves to death either. Um,
Yeah.
so I think you have to be cautious of that. I've actually, the companies that, where the friction isn't, are they spending every dollar efficiently? But the conversations are, hey, are they taking enough time off? Are we rewarding them the proper way for the effort that they're putting in? I just rather be having those conversations rather than the previous ones, right?
Yeah, I would say though that in this day and age, I haven't seen a company really that's yet too lean. If anything, I think we need to trim rather than add. I would say that it is important. Again, I put a lot of the burden on the CEO to understand what's necessary from a scale perspective. But I would say the way I look at this and is if we're like, oh hey, like for instance, in my company at Candid, we were running some stuff where we needed someone to oversee some toxicology studies through a CRO. Um, so rather than hiring a toxicologist, I actually said, who in the company can actually manage this? And my head of program management raised her hand and said, look, I think I could do this. And she did it for like 6 to 9 months. And then it got to a point where there was just so many programs that got technically more complex that we needed to bring in that toxicologist. But I would think rather than reflexively thinking we need to hire someone to fill that need, look around and be like, hey, does anyone have a little extra bandwidth? Well, do you want to try and take that on? And And I think as long as you're curious, you can really learn most things.
Yeah.
Um, you know,
Elaine,
yeah.
Elaine had a question in there about investors being incentivized to write bigger checks because it's the same amount of work whether I write a $5
Mm,
million check or a $20 million check. That is absolutely true. The amount of work is the same. My bet is that if you stick with the mantra of from your entry point to that clinical endpoint, you're going to have plenty of time to put that other $15 million into the company. This, you're right. The first amount of work is the same for the first $5 million, but you want to put yourself in a pole position to say, I want to buy all of the next round. And by then,
mm.
that's when you're going to get to put more of that money to work.
It's great. Look, there's a lot of questions that are coming in. I think some of these can deserve their own webinar, like China. I think we're going to address that in the next minute or so. I would say this is if there are specific topics that you're interested in hearing about, just send that to Elevate, send that to Elaine, because we are looking to have different types of webinars through the course of 2026. But again, in the interest of trying to do what we preach, which is being efficient, I think we're going to sort of close it out here. And so I would say, look, Elaine says send it to inquiry at elevatebiotech.org. So that's two A's. But look, I would just say this is look, whatever you're doing and whatever you're looking to do for the rest of this year, spend less, do more, and move faster. So, Merry Christmas and Happy New Year, and hope to see many of you in 2026. Bye, everybody.